You're listening to the Scotiabank Market Points podcast. I'm your host, Greg White. Market Points is part of the Knowledge Capital series, a collection of audio, video, and written commentary from Scotiabank Global Banking and Markets leaders designed to provide you with timely insights and analysis. The experience of operating a business during the COVID-19 pandemic has contextualized the meaning of risk for many business owners. Business has always been a risk-reward trade-off, but successful businesses understand which risks are the ones that are worth it. Innovative R&D, investing in building inspiring corporate culture, a groundbreaking advertising campaign. And they make a conscious decision to remove the risks that aren't at the core of their business purpose. Things like interest rate and currency uncertainty that could threaten their cash flow and ultimately the business itself. On this episode of Market Points, Scott Morrison, Managing Director and Head Commercial Derivative Products and FX Sales, explains how hedging strategies work to keep businesses moving through uncertain times. Hi, Scott. Welcome to the podcast.
Thanks, Greg. Thanks for having me.
The pandemic has ushered in tremendous uncertainty, and we're not out of the woods yet. How have Canadian businesses been handling risk in this environment?
I mean, just in context, what we saw during the peak of the pandemic there, and I call it peak back in March, we saw the dollar Canada or Canadian dollar effectively trade in a 15-cent range in dollar Canada terms or 8 cents in CAD terms. And those levels are pretty historic, monumental moves from a perspective when you look back at other times in history. No forecaster had expected the Canadian dollar, at least no forecast that I had seen prior to the pandemic, calling for the Canadian dollar to weaken off, and a number of our U.S. dollar exporters were able to take advantage of these unprecedented moves. As well, we had other clients that took advantage of historically low interest rates that had been brought forward by way of central bank moves throughout the beginning of the calendar year with unprecedented cuts, and as a result, interest rates for clients to fix were relatively historically low. And we also saw that the volumes that we had seen over the period of March and April were probably 2 times what we normally would see as a normal run rate of volume from our clients dealing at that time of year, kind of year over year.
The core of your business is medium-sized commercial entities. What's unique about their situation in handling risk?
We often see a lot of mid-market companies. They're owner-operated. These entrepreneurs have started these businesses from the ground up. They built them from the beginning, from their garages, from their basements, where have you, and they've built up successful businesses that are now meaningful in companies employing actually a good sized amount of people in large cities and small cities all across Canada, for example. So they're very good at what they do, and what we find is that they because they like to take risk and they wear multiple hats, they often deal with fires at hand. And if I use that metaphor, fires, they tend to have an operational problem that they may be focused on, or they may have an HR issue that they're having to deal with. And they wear the CFO hat, they wear the operations hat, they wear the HR hat, and a number of other different titles within the company. Even though they may have those individuals who have those jobs, they ultimately see themselves as, if I use the term, jack of all trades. And that's what's made them successful, is that they have their finger on the pulse within their business. And our focus for those clients is to explain to them that at the same time that there's not necessarily a fire to put out, whether it be interest rates are not expected to go higher. I mean, when you look at any central bank forecast for short-term interest rates, central bank forecast for many of the Canadian banks, for example, you would notice that no one is calling for interest rates to go up anytime soon here in Canada for at least the next year or two. So it's hard for those owner operators to focus on, if I use that term, fire, because it's not a fire to put out. They don't have to worry about borrowing costs going higher. Our job within the bank, and what our team is focused on, is just really to highlight stress tests for those companies. We want them to think about their situation and just acknowledge that by doing nothing, they're doing something. And if they choose to not take chips off the table and fix their costs, or whether it be with an interest rate hedging product, or whether it be a currency product which can allow them to fix their known variables for a term, uh, they're effectively choosing not to fix or lock in today because they feel like the future is going to be better. And as long as we have that conversation with them, we can help them identify the gaps and help them stress test their business.
What's the environment look like right now when it comes to rates and currencies?
Right now, you can fix a rate relatively close to where you can float the rate, and actually where you're fixing the rate is well below where you were actually floating the rate at the beginning of the year if you were to go back and look at where historically these rates have been at. And so when we talk to these clients, we just try and focus on it's a budgeting and forecasting exercise to lock in at these low levels. And there's actually an opportunity right now within this market for a lot of companies to lock in at historically low levels that maybe they're not aware are available to them. The fact that you can fix pretty close to float, the fact that you can lock in your currency pretty close to the prevailing spot rate. And there's various types of products that we have once we go through a suitability assessment and working through their stated goals, we can provide solutions to them to achieve what they're trying to do for their company.
It seems like the larger the firm, the more likely the company is to take advantage of risk mitigation opportunities. Why is that?
I think it's the fact that large companies have been able to take, generally speaking, the emotion out of the equation. Large companies have boards, and they tend to have hedging policies that are predetermined for a treasury official or treasury person to manage towards. So they know that the board has mandated that that company has to fix 75% of their floating rate debt for fix. The board has stated that that company needs to has defined that they need to hedge their currencies for 100% of their exposure for year one exposure and maybe 50% of their exposure for year two. And potentially some companies have 3 years of exposure that they're looking to hedge and they may look ladder it down to 25%. And they have prescribed hedging policies that outline what is required. And that way they can all look back and say, why did we do this in hindsight, whether it worked or didn't work? And at the end of the day, they had a stated policy that they thought about and put in place.
I would imagine the transition for several entrepreneurs to becoming larger and larger businesses is difficult. They're so used to taking on risk and that being part of their success.
Well, yeah, it's a great point. It's because that's what made them successful, and you hit the nail on the head. Risk is how they got to where they are. They started these businesses often, with not a lot of money, and the capital that they were able to pull together in the early days. They bet all on themselves, and they executed in a niche business, and they've made a lot of great choices along the way by trusting their gut. And so we really try and take it's again focusing on the emotional part of the decision, take the emotion out of the equation. For example, back during at the beginning of the pandemic, when equity markets were selling off just this year, each day in and day out, they were selling off to new lows, and we bottomed out at 30+% in the equity markets. Well, if you were emotional at the time, and it's easy in hindsight to look back, but even if I think about myself and if you didn't have the long-term view, you could get scared and end up selling out of those positions. And now fast forward to today, 8 months later, really not that far away. And next thing you know, you have equity markets today hitting all-time highs. And so really moving the emotion out of the equation and getting back to what is your goal? What's your long-term goal? And working with experts to help you achieve those goals is really what a successful business needs to do.
And so, I guess the big question is for executives and business owners is what's the forward looking view right now in terms of risk?
I would say that our base case is that we're going to see some stability here in the market. There's a lot of hope out there with vaccines headlines coming through day in and day out, and it's very impressive what's been able to be achieved in a short period of time, and hopefully that story plays out as we expect. What when I think about how business owners need to manage their risk, I'm concerned about complacency. And the market has an impressive way of finding the sensitive points for business owners, individuals, anybody. And we talked about taking the emotion out of the equation earlier in the podcast. And when I think about where we are uh, today, you could get lulled into a sense of complacency. So I'll give you an example. Back in 2007, we had the Canadian dollar, which traded to the all-time levels in modern history it ever got to. If I talk in dollar Canada terms, it went through parity, so it got down to 90, a little over 90 cents in dollar Canada terms. And so the strongest point the Canadian dollar had ever been, and the weakest the US dollar had ever been against the Canadian dollar. And during that calendar year of 2007, you had the dollar Canada rate go from 112 within the spring of that year to the fall of that year when we made our way through par for the first time. And when we went through par the first time, or down to those levels, you had a lot of excitement from U.S. dollar buyers and just the general public. You heard stories of people going down to the U.S. and buying uh, cars and importing them back into Canada at a par dollar. You heard of people going who had the means to be able to go down to the U.S. and buy vacation properties in U.S. dollars, and you heard those stories. But what was interesting back then, from my perspective, we saw a number of US dollar sellers come in to sell forward their currency. So their receivables that they had expected to come in over the next year, whether it be for 2007 or calendar 2008 at the time, they were hedging their sales. And I can remember talking to one of the business owners, or a number of business owners, because it wasn't just one client that we saw do this. I remember saying to them, "Why are you selling forward at the strongest point that the Canadian dollar had ever been in modern history?" Um, and their response was, "One more cent, and I'm out of business. This is the only way I can preserve whatever margin I have left in my business." And what that said to me at that time, back in 2007, is, and the market has a way of finding the vicious points. I mean, these are the same business owners that were able to be in business and enjoy 2002, where you had dollar Canada trading at 1.5. So again, almost the weakest point the Canadian dollar had ever been in modern history. Fast forward to 2007, you go to par. Today we're at 130. It's hard to say. I wouldn't expect us to go back to par, and I don't think we're going to go back to 150. But I think the market has an ability to find its vicious points, and interest rates are really low at all-time lows, pretty close to zero. Can they go to 10%? Probably not. But could they? Who knows? And that's what I want to leave with our listeners, is that you want to manage risk and not deal with fires. You don't want to have to deal with a fire. You want to deal with these problems ahead of time. And we have different products that we can help clients with to mitigate some of this risk and really manage their bottom line, and so that they can focus on doing what they do best. It's making that widget or providing a service or whatever their business is.
That was Scott Morrison, Managing Director and Head Commercial Derivative Products and FX Sales at Scotiabank. You can now find Scotiabank's Market Points on Apple Podcasts, Google Podcasts, and Spotify. Don't miss an episode. Subscribe on your favorite podcast platform. And we want to hear from you. Please rate and review the show. Your feedback helps us improve the content we create for you. You'll find more thought-leading content on our website, gbm.scotiabank.com. And you can also follow us on Twitter at ScotiabankGBM, as well as our LinkedIn showcase page under Scotiabank Global Banking and Markets. Please refer to our legal disclosures on our website. I'm Greg White. Thanks for listening.